Well, thank you very much, Barbara. It's a pleasure to be here with the cleanup hitters. And I want to start, if I may, by telling just a very short story. Some of you know this. I gave a talk about a month ago in New York. 2 days before that, I nearly got killed in an auto accident. And it was an incredible situation. I was driving with my wife into the city, and she says, "Bob, watch out." And I looked up, and there was a truck coming straight at us from the other side of the freeway. We were going about 70 miles an hour in pouring rain. I slammed on the brakes. It was a tanker trailer. What I didn't know is it had already had an accident. It had hit a car far on the right side, was out of control, on fire, and it was carrying 9,000 gallons of gasoline. It immediately went up over a median, plopped down in front of us, and we were able to swerve around it. It burst into flames. The heat was incredible as we went by. We were probably going 20, 30 miles an hour as we went by. Our car was covered with oil coming from the front of that tanker that had hit that car. And as we looked behind us, there were flames going 200 feet into the air, and there were no other cars coming. It stopped the freeway, and for 7 hours they were cleaning up this incredible mess. I think, and to me, it was the powerful thing about that. It takes a while to get over it, but that's what we're facing with climate change. It's the risk of what's coming at us, and as a society, as a global society, it's like my wife saying, "Watch out." We've heard the watch out. We have not yet slammed on the brakes. And we don't know, if we had been a second earlier, we would have slammed into that truck. And we don't know how much time we have as a global society. So to me, it's all about the brake. We've got to hit the brake. And the brake, as an economist, as a risk manager, it's very clear what the brake is. The brake is the incentive to reduce emissions. We have to price emissions globally. We have to price it appropriately. And economists and scientists have looked at this. The US government has said the appropriate price for emissions is about $40 a ton. The recent IPCC synthesis report had a very interesting table in there. It's mostly about science, but they had a table that basically said the problem with economist models. They said, we don't trust the economist models. And they were absolutely right. I'm an economist, but they were right. They said those economist models don't take into account the worst case scenario. And they're right. The economist models, for the most part, project known damages. Kate Gordon was terrific last night, and she put the risk framework. There you are, Kate. Terrific. But we don't know what the worst case are. You talked about all the things you didn't include because we don't know. It's absolutely true. We don't know what pathway might lead to a breakdown in the global ecosystem. But 4 degrees of warming or 2 degrees of warming, it's incredibly dangerous. And so we've got to get started immediately. Now that informs my thinking about investments. And I just want to tell you about something that we did at the World Wildlife Fund, where I'm the chairman of the investment committee. And this is, we face the same issues that universities face, maybe even more so, because, we're an environmental organization. Protecting the environment is part of our mission. Knowing that at some point we're going to price emissions, we wanted to prepare our portfolio for that. So we worked with Cambridge, and they did a terrific job for us. We said, help us to identify the assets in our portfolio that will be negatively impacted when emissions are priced appropriately. And they said, all right, and there's a literature out there, people call these stranded assets. It's a broader concept, actually. You could talk about water and things, other externalities being priced, but with respect to climate risk, emissions are going to be priced. They're going to be priced, I think, sooner and at a higher level than people realize, because this is the brake. And we are, I think, at a tipping point. And I show this graph. This is a swap. It's an overlay on the portfolio. One of the things Cambridge said to us is, you've got little pieces of stranded assets, basically coal and tar sands, throughout your portfolio in private equity and hedge funds and public equities. It's going to cost you an arm and a leg to reduce that to zero. We actually sold a real asset fund where about half of it resided, but the rest of it was spread out. So we worked with Cambridge to come up with a very simple derivative structure where we sell the total return on coal and tar sands, and we receive the S&P. I like this. Number one, it was cheap. Number two, it hedged our risk, our stranded asset risk. And number three, if you think about it, it's a very pure bet. It's a bet that stranded assets are going to underperform the market. That, to me, is a bet I like. Okay? Now, I don't want to think about it as a bet, but that's economically what it represents. And I wanted to show this chart because, as you can see, it did very well last year. I don't know if you can see the small print, but we had a cumulative return of 33%, actually more than that last year. And that was the best performing thing in our portfolio. In some sense, it's too bad it was a tiny, tiny piece, but it did work out very well. But more than just the fact that it worked out, you notice for the first 5 months, it did essentially nothing. It was down a few percent. May of last year is when Stanford University announced that it was going to divest of coal. That was when this thing started to perform. Then in September, Yale University made an announcement. They said, we're not going to divest of coal, or fossil fuels, I should say. And, but at the same time, they said this is a very serious issue, and it does impact our endowment. There are things that we have to do. And David Swenson, who is, as I'm sure all of you know, one of the most respected investors out there in the endowment space, or more generally, he wrote a very strongly worded letter to all of his external managers saying, you know, this is real, it affects all of our investments, and we want you to think about the implications of climate risk as we go forward in everything that you do for us. And as you can see on that graph, starting in September, this swap started to pay off very nicely. Then there's kind of a flat period and a little blip there during the November election when the Republicans won. And people thought, oh, this is good for coal. Well, it was a very small blip. And then you had the agreement between China and the US, and you had the Lima conference, and that thing has just performed well. And by the way, the background here is that although we didn't have the swap on in the previous 3 years, stranded assets have underperformed the broad market by an average of 18% a year. So coal is basically now, and stranded assets, falling off a cliff. And I think that represents the rising expectations globally that emissions are going to be priced appropriately. So from my perspective, this is happening. It's very important, and it's something that people should be very cognizant of in their portfolio. And so anyway, that's my introduction and my experience. So now let me turn it over to our other experts. And Alice, let me start with you. How does your company begin the process with a client who wants to align their investments with their values?
Okay, so we're charged with being a little more practical than perhaps, and getting these ideas, these very important ideas, into sort of how do you do this in your portfolio. So I'm hoping you can read better than I can see on the slides. One thing that differentiates the experience that consultants have with clients that seek to do something in their portfolio about climate change or about social issues is that the starting point is much more of a process. So what I mean by that is consultants like to go in, try to rescue the day, you know, do something with your portfolio meaningful, and we usually ask questions like, what are your debt covenants? What's your spend rate? How reliant are your operations on your endowment? Those are easy questions. Most CFOs could answer them in their sleep. Then we have clients who seek to do something in their portfolio that reflects their values. And all of a sudden you have a mission statement that you need to develop, and there are no easy answers. So we have, through trial and error, developed some questions. This is a working draft. We learn from our clients and change it along the way. But I have found with these clients that this is an essential part of the process, and you have already heard that here multiple times, that involving stakeholders And this can range. I think Liz was up here from Aperio mentioning, campus-wide survey. It can be, having 1 or 2 students, a couple of donors, or whoever in the room. I've had another client who's a government organization who just really relied on their board and their investment committee. But it's very important, those first 3 questions, to establish what is your mission, who are the important stakeholders, and get that mission statement into your investment policy statement. That is your guiding document. And I would say that for those of you who struggle with it, I think that we've heard the question about outsourced CIO model. If you have a working document that says this is your mission, and you want to align your investments to that mission to the full extent possible, and you give yourself some flexibility there, that outsourced CIO has a fiduciary responsibility, as we've been talking about, to follow that statement. They don't really have the option not to. That is your guiding document. So if you can work through this process, and it is a process, I think at Hampshire College it took a year or more. I have another client who it's taken about 3 to 6 months. I have another client who's a private foundation, and with them it was much shorter because they don't have as many stakeholders to answer to. But it will be a process, but it's an important process. I would say if you don't go through questions similar to this, you end up losing ground because you back up. One client in particular, we started moving down the road. They thought they knew what they wanted to do. They hadn't talked to their various stakeholders. They hadn't really made a concrete mission. And we just ended up going back. They ended up having 3 meetings on sustainable and what they called, I think, a sustainable investment subcommittee. And then had really good conversations about what they wanted to do and how they wanted to do it. So the first 3 questions are, I don't want to dwell on all of these, but it's really about establishing that statement, that mission. And the second 2 are more about how do you want to do it in your portfolio. So there's no one right way. I think you've heard that up here. You've got a total return swap. Some people decide to do below market rate loans to community, to various investments. I've got one who has some below market rate loans to some farms in Vermont because they're trying to work on sustainable farming. So there's a wide variety. You can do it in your portfolio. You can decide. Some committees have decided we're using our grants and we're going to be more cognizant of what our grants are going to and try to influence climate change that way. So there's a spectrum that gray bar represents. And then something that's important in that context is what are our people resources and what are our time resources. Because if you decide to do something like shareholder activism, you can guess that by its nature that's a little more time intensive. If you decide that you're happy just divesting, this just doesn't, I guess we've made it sound not that simple, but divesting from fossil fuels, at least in your index funds, is a relatively simple proposition. So you have to think about how much committee time, how much student time, what do we have available to use. This is a few more questions in that spectrum, so I'm not going to, again, go over all this. The first one really talks again about what your options are. In this room, because we've been talking about climate change, the 2 main options that tend to come up are, well, 3 really. One is, I'm going to just divest, which is a negative type of screen. The second is, I want to consider social and governance as well as environment, and I'm going to broadly look at investors, investment managers who can do this for me, who are aware of what's going on and who integrate this into their process already. And the third one is, we've talked about some, and I think it can't be talked about enough. I think shareholder engagement can be very powerful, especially for universities, if you can get a student group who's interested in that. I think there's a variety of people, Boston Common and Walden, who can help you work with that, the series, the INCR network. I think there's a lot of people out there that can help you get going on that. At Hampshire College recently, we had Boston Common come talk to a group about shareholder advocacy. And the last part is more about, as investment committees, they often are very concerned, as we've all been talking about performance. So you want to consider how much in your portfolio, how much can your community accept as far as short-term performance deviations. Over the long term, I think a lot of charts you've seen show you that if you remove fossil fuels, you're going to have a very similar performance over time. I think we've done some work with Aperio. I think since 1988 to 2013, there was 10.6 annualized return for both the Russell 3 with and without consumable fuels. Same thing. But short term, you're going to have some deviations. So you need to talk about what tolerance you have. Do you have the ability to go to your board and explain the performance? Do you have the perseverance to stand by the mission that you set? So those are the main ideas that you have to consider when putting together a portfolio. This next one is something about just, knowing what's in your portfolio. I mentioned this at the April conference. It's worth knowing again. If your managers are coming to you, or your consultant, or your outsourced CIO, and saying they can't tell you what's in your portfolio, that's unacceptable. I don't know how else to put it. We developed this chart, and I would say it's much easier in your quote-unquote traditional portfolio. So in your stocks and your bonds, there should be no trouble finding out, even if they're in commingled funds or a mutual fund, what's in your portfolio. If they're in a mutual fund, you should be able to ask your fund company, if no one else, but your consultant or investment manager should be able to tell you what's in your portfolio, and then do a summary chart to analyze just what % exposure you have. So this is really to address, I think there's a number of categories on here, but fossil fuel exposure, coal exposure. Some of our clients aren't divesting, so they just want to know how their portfolio ranks, sort of, in environmental, social, and governance concerns. So that's a different topic. I would say that's hard for us as consultants to do, at least from our perspective. We're not the experts to balance that, which is more important from a social sense. And there's experts out there. MSCI is an expert. Sustainalytics has been mentioned here. IW Financial. They can take your portfolio and rank it for you, and that is what one of my clients is doing. They're ranking their portfolio before they begin to see if they are making improvements on those factors. So that's another option for you. This is a chart that we've also used. So you've decided if it's in your IPS, you're going to either divest or you're going to implement, you want to be more aware of environmental, social, and governance factors in your portfolio, and to have your managers think about those things when they're investing. So what we've done for clients is formed a matrix. On the left-hand, trying to think from your point of view, the left-hand side is holdings where we have complete transparency. On the right-hand side, there's going to be some holdings like your hedge funds, where we basically have to send to them a question saying, are these in your portfolio? We have access to their long holdings. We may have access to some of the shorts, but we don't have complete access, especially in fund of funds. So we ask them whether these stocks in the portfolio, by and large, our managers are willing to answer that question. So, this gives you an idea of where you're going to have 100% transparency and where you're not, and then breaks it down into, do we have investment options today, right now, that we could give you to replace the options that are in your portfolio? You can see at the top of this chart, on the top left-hand box, that the easiest thing to do is choose a different index fund. And there's more and more coming out, and so the expenses are going down. So BlackRock, just many of you may know, developed a product that has a 6 basis points fee, $5 million minimum. It's a global product. It does developed only ex-fossil free. And they define fossil free very specifically to be producers. So there's about 75 companies that they take out of the portfolio. So that's just to say there are options. There's separate account options. And separate accounts don't have to have huge minimums, especially if you're just indexing an equity benchmark, a stock portfolio. So both globally and domestically, you can pretty easily change that part of your portfolio. And then we have a number of active managers. You've heard from some of them, Impacts today, Boston Common, where you can have active management as well. So usually in the equity portfolio, in the stock portfolio, it's pretty easy to change. Second box down, you see, and the one other part, I think you mentioned this, and we had a commingled, in this client's fund, we had a commingled real asset vehicle. That meant, not commingled, but a bundled approach. So that meant they invested in TIPS, Treasury protected securities, inflation protected securities. They invested in commodities, natural resource equities, and real estate. Client did not want to be in the natural resource equities. That's where your ExxonMobil and Chevron are. So we just disaggregated that and found other investments to be in. They were comfortable doing treasuries. They were comfortable doing real estate, and we felt like that was okay as an inflation hedge. So the next box down is We don't have any really good options to change out of, but these are unlikely to be a problem as far as your environmental, social, and governance concerns go. So that you can have a different opinion about that, but for us, that's treasuries. People have different points of view about whether government bonds are a good or a bad thing. We have some non-US bonds. Also, there's sovereign, they're government bonds in portfolios, and those are usually acceptable to most of our clients. So those are things that we don't have investment options to replace them, but they're not likely to really be in violation of your values either. And the last box is where, we're still working on this. Emerging markets equity is, we're still working on this. We continue to review options. Boston Common just came out with one in December. There's a couple others that we're looking at. So, and that's one of those things. This is a process. So you start where you can. You start at that top box, and then you work through the other boxes. And lastly, you're sitting through this and you're like, there's no way, either with my stakeholders or my investment committee or whoever, that I'm ready yet to do something about my portfolio. And I would say, from our perspective, and I've heard various views up here, and it'll be interesting to hear what Tom has to say, there aren't enough managers out there yet that are doing this well to populate a good-sized portfolio. We continue to seek them. Our options have definitely grown in our firm over the past year, but we have fiduciary responsibility too, and we have to look at performance to some extent. We need to look at the size of the fund. We need to look at risks in the fund. So if you do nothing else, I would say it's a good idea to go out there and ask your investment managers or through your consultant, ask questions like the ones I've listed here to see what they're doing. Some are, more and more are starting to do something in their portfolio, at least to consider this. So questions like, are you signed on to the PRI? And not just that, because that can be greenwashing to some extent. What have you done to further yourself along any of the 6 principles? Give us clear examples. When you talk to company management, do you also talk to the chief sustainability officer? Do you ask them questions like what part of the business they have come from and who do they report to? How do you consider climate change when you're valuing a company? How do you consider their social record when you're valuing a company? How does that go into your investment thesis? So I actually need to catch Tom at the end of this and think through this. I've talked to someone from PRI, and we may develop a list of questions that we can put online that are easy for you to ask either your consultant or your managers. The more you ask, your managers will develop the products. You can see it already. MSCI BlackRock has come out with not just the commingled fund I mentioned, but a couple of iShares products. So you're seeing the Fidelities at conferences, I think you've heard here. You're seeing other managers. We had 2 managers at SRI in the Rockies who were actually on our recommended list, and we didn't know they were doing anything. And so they came into our office in the past month, and we've had conversations. It's extended to the point where they have an ESG analyst, one, in their firm. And so, yes, they're doing something. They're starting to have the conversation, and we'll continue to talk to them about how to further that along. But you are an important part of that. You are the customer. Don't forget your power, and ask them what they're doing and how they're considering this. Because the more you ask, the more products there will be, the more good managers who are both concerned about financial return and the environment and social impact there are going to be.
Great. Thanks, Alice. Erik, you've recently been working with Rockefeller Brothers to manage their portfolio under an ESG mandate. Is this the first engagement for Perella Weinberg, or have you done this before?
So in the area of ESG, this is the first mandate. It's the first client we've had that has the mandate in their guiding document, which we referred to, which is their investment policy statement. The Rockefeller Brothers Fund, or the RBF, as they're known, made this decision a couple of years ago. They are within an outsourced CIO model. They had a firm prior to ours, which is actually a very good firm. But they had the commingled fund problem, which is where that OCIO has a series of commingled funds by asset class, and that OCIO was unable to provide what the RBF was looking for in terms of becoming fossil fuel free. And like idiots, we stepped up and said, well, we can do that. How hard could that be? And it turns out it's actually really, really hard to do. I said this last night at dinner. But we wanted the business, so we said, sure, we can do that. And the big thing with the RBF was, yeah, but are you really committed to this, and are you committed to this space? Or is this just, you know, another kind of account in the win column? And we said, no, we're completely committed to it. And I think we really just wanted a win in the win column, not knowing what it was going to take to do this. But we were interested in it. We were interested in it more from kind of selfish, capitalistic reasons, which is this is being talked about all over the place. Arizona State has been talking about this for a long time. Maybe there's a business opportunity here in terms of new clients. So this is the dark side of looking at this as an opportunity, but it was an opportunity. And so the RBF went down a path. They had a very kind of thorough selection process, and they chose us, and then we all looked around the table and kind of said, now what do we do? And given the rules of the conference here, I think I can talk a little bit about it. You have a staff and you have a CEO, kind of leadership of the RBF, who definitely is on one side, and you have a very sophisticated investment committee that are made up of a number of financial professionals who are not on the other side necessarily, but come at it from a different approach. And we sort of sit in the middle with like black and white striped shirts on as referees. And having them try and figure out where they want to go is sort of the key issue. You laid out, Alice, a bunch of questions, you know, that clients need to ask themselves when they go down this path, and I think that's exactly right. And the main question is, what do you want to be? And what do you want to do? And everyone wants the same thing, but they want it in different priorities. They both want to earn returns, and meaning the investment committee, the governance body, and the organization itself. They want to earn returns, and they also want to do something for the environment. They just want to do it in different priorities. And that has a major impact when you're trying to build a portfolio. So we can accomplish whatever they want in terms of, you know, what is a priority, but you just have to agree on the priorities. And I think the challenge for the RBF is they are blazing that trail now. They made a very public statement at the UN back in September, and that created a flood of inquiries, you know, lots of managers calling, lots of questions about how you're doing it, and I wouldn't try and fool anyone. We're in the second or third inning of this process with them. But it's an interesting process, and it's one that we're learning a lot about. I'd agree with everything that you said, Alice. I think it does go back to the guiding document. That's the only way we know where to go in terms of managing the portfolio. And we're going to disappoint them at times that we're not moving fast enough down certain paths. And in some ways, we're going to go too fast down other paths. The challenge, I think I said this last night, the challenge of finding really good investment managers who are in this space who satisfy that impact requirement is really, really hard. There's lots of them out there. There's very few that pass the typical screen you'd have to build a portfolio. They're growing. The numbers are definitely growing. But that's the really tough part with them right now.
How long have you been able to eliminate the fossil fuels from the portfolio, or how long does that process take?
Yeah, they have today, I think it's just under 4%. It's probably 3% given what's happened since August in terms of oil prices. They have a series of commingled funds that were there prior to us being there. We converted a lot of the portfolio to separate accounts because that's a really easy way to start screening things out. They have a, I don't know if it's a mandate, but call it a guiding principle of no more than 5% in fossil fuels for right now. As we transition over time, if you're not committing to new fossil fuels, and hopefully the portfolio is growing over time, mathematically that'll go down, you know, even further. The big win we had was that we told them we can't get to zero. You just can't get to zero and still look for an endowment-style return of 8 to 10% over 20 years. At least we don't know how to do that, because that's going to wipe out a lot of commingled funds, some of whom may agree to carve out and have share classes that exclude certain things, and most of them are not willing to do that. And you have an adverse selection problem, which is those who are willing to do that may not necessarily be the ones that you want to invest in. So that was a win for us, which is give us time to get through this. RBF takes the negative approach, which is we want to be out of this stuff, and they have a positive approach, which is we want to be into this stuff, which they define as impact. But they don't define it any further than that. It's sort of up to us to figure out what does impact mean. And for an organization like the RBF, whose mission statement is, I'm going to get it wrong, but it's something like peace and democracy in the world. It's pretty broad. you know, that could mean lots of things, right? So what's happening now is if the negative side is easy, the positive side is all about, well, what constitutes impact? In their investment policy statement, they have a stated 10% minimum goal of impact-oriented investments. And that's really easy to put in a document, and that's really hard to actually implement when you start to sit down and discuss it. As an OCIO, we have discretion over the portfolio. We're a fiduciary, and I agree completely with what Alice said. We have to know everything that's in the portfolio. It's unacceptable to say that we don't. But having discretion in something like that, where we're supposed to go find impact investments when that hasn't really been defined, is tough. So we've looked at things ranging from classic renewable energy sources, which sort of makes sense for what the RBF is doing, to workforce housing, to investments in southeastern China, which is an area of importance for the RBF for historical reasons. And so that's where we are today. And all that stuff actually has to pass the normal investment screens that you'd go through for any kind of manager. So it's the positive side and the negative side that are sort of coming together. It is truly a fascinating process, and a lot of people are looking at us to see how this all works out. But as I said, we're still early.
Great. Tom, you know, Cambridge Associates has been doing mission-related investing for a long time. What are some examples of the ways that you've worked with your clients to implement that?
Thanks, Bob, and it's been a great 2 days, so thanks to all of you. You know, I'd say that, you know, we've looked with our mission-related investing group at some of these structural barriers, if you will, maybe in a few different ways, and we'll echo a lot of what both Alice and Erik have said. The first thing is, I guess a barrier is having commitment. And so you need commitment from the institutional side, but also as consultants, we need to be committed to this space. So first and foremost, it was forming our mission-related investing group, which Jessica Matthews is our leader of that practice, and could give you a great perspective on the journey of, just even as a firm, of how we've built our own capabilities, resources, and continue to learn. This is a rapidly growing space, but we saw the business case. Same thing, I mean, it wasn't out of altruism that we said we need to put resources into this and build a group, that we think that there's a great demand for this. And I think if we look across 1,000 clients globally, we feel we have a good insight into the market for largely institutional investors. And we look at that graph over there, you know, I would say that north of 120 clients are somewhere between constructive deliberation and investment policy with a track record, all in very customized fashion. We have a lot more, and particularly when it comes to college and universities, talking about divestment and ESG, that some are in that spectrum, but then there's others who are, like possibly many of you, figuring out where to get started. So it's a commitment to information, knowledge, and learning. A lot of that's happening here. I think Alice laid out the process is very important. What's really challenging with that, I'd say, you have to ask all those questions, and where people get frustrated with consultants is sometimes they want the consultant to tell them the answer. And when it comes to saying this is what we want to do, and this is where it aligns with our mission, and this is what the impact we want to have, I think that, you know, my view, and that's shared by others in our group, is that at some point our clients need to own that too. I mean, if that's not right here, then it's going to be really hard to carry through and work through those difficult decisions where not everything is cut and dry. And so that process is important, but you need to have good active engagement on both sides. So, you know, consultants are a barrier, and if your consultant or your advisor is not helping you in the way you should be very explicit about what you want to try to do. And you'll find, I think most of them are very interested in serving their clients to the utmost. So make sure you have that good conversation. There's a lot of other consultants that aren't on stage, but are here in the room and have devoted a lot of resources to doing the same. The other thing, which has been going on here today as well, is in something that we've done to help our clients and others, is information sharing. And how do you measure what's going on out there? Because there's a lot of good information and bad information about impact and ESG investing. And so there's a couple things, and this will be, so for George to take notes. We have publicly on our website, I think we have the most comprehensive measure of private investments in clean tech that's available. So one thing we've done there, for example, and I think it's totally under the radar by most people. I think we're well known, also on our website, publicly available, are private equity and venture capital benchmarks people can go source. If you scroll a little further down the page from that, you'll find a clean tech report we started almost 2 years ago, quarterly. And so what we did is said, instead of measuring funds like we do in a private equity and venture capital benchmark, we looked at deals. So currently, we've got 1,338 deals from 452 funds representing $25.6 billion of capital paid in to clean tech deals. And clean tech, it came up earlier, and the question Karina answered yesterday, that it gets a bad rap as a big sector, and there are some challenges. So we've disaggregated that into 4 broader groups. So you do have renewable power manufacturing, so that's really capital intensive, and frankly, that's the part that suffered the most from a return perspective since, say, like the middle part of the 2000s. The second group is more renewable power development, and that's where you can see the financing, the installation, the operations, those type of investments in there. Energy optimization, so I don't know if any of you have a Nest thermostat in your home, or or driving a Tesla or whatever, but those sort of things would fall into those deals. Then you get into resource solutions. That's your recycling, water, wastewater management, all those sorts of investments. And then within that, there's 16 subsectors. It's an 18-page report, so I won't go on, but that is something that right now the most current one is Q2 last year. So private investments, you have a 3-month lag, and then we have to go through and look through and update the detail. But that's something all of you can access and use to have a more nuanced conversation. And really, when you get in that process and you get into the questions that were so expertly laid out, is there's a lot of nuance, and you got to be able to navigate that nuance, both as an institution and as advisors. Currently, Jessica is working on defining impact investing benchmarks with the Global Impact Investor Network. So those, again, will be publicly available. That's the GIN, if any of you heard that. So that's more akin to what Adam Seichik talked about yesterday, of some of the impact investments are more illiquid, looking at the peer-to-peer lending things that he was doing. And so that's private investments and impact investments. There's just never been a benchmark for those type of investments. And so when people talk about market rate of return, I like to say, well, there are thousands of different markets in the world. So what is the economic potential of a given market? And this will get us towards starting to measure that. And so that's, again, information sharing. The Emission Investors Exchange, which is more foundation-oriented, we provide information on managers and a certain level of our manager database so that people can locate investments. So I think that's an important barrier, and things like this network can really help shine light on where that information is. Because there's no shortage of information in the financial world, and you have to know, really, everyone wants to know how to cull their inbox to what's most useful. So hopefully this network is helpful for that. And then on investment product supply, I agree with everything that's been said, that there are many managers in this room that are good ESG managers. We have over 800 managers in our proprietary database that we call our mission-related investing database, many of whom are ESG. About half are public, half are private investments. And the list, though, of what's in our database, so what actually gets invested in by clients, becomes much shorter. And that's, again, you're looking to meet the risk-return objectives of your clients and get really high-quality investments. And so this space is growing tremendously, and there's been a lot of new entrants to the space, and so we track those. We meet with over 100 managers a year. About a third of those meetings on average for the last 4 years we've looked at it have been with new managers. So those are things that we're tracking. Jessica's adding resource capacity to the group, so I don't want to put a number on it, but I think that number is going to go up significantly as we scale the research effort. And so that's been great. I mean, having this dedicated group has really helped us focus and get to know a lot of you in the room on the investment side. But at Cambridge, we cover investment managers globally. And so in many ways, I think David Swinson scooped us with this letter just because we're a large firm and it takes a while to move, but we were already underway in a process that's looking at how we integrate ESG inquiry into our broader manager research. So of the 30,000 managers in a global database, I'd say only a couple thousand are ones that were more merit serious consideration for investments with our global client base. And so instead of just looking at the 800 MRI managers, we're going to go out to these 2,000 managers, say, give or take, and we'll be asking them some of the questions that Alice presented. So, whether they consider ESG, how, if not, why not, and diving deeper, both from a conversation, not that just some of our young analysts are sending to another young analyst at an investment management firm with a questionnaire. That will happen, and we'll gather that data. But it's also going to be professionals that sit across from portfolio managers and meet with them on a quarterly basis and talk with them about their portfolio, asking the question, which I think is much more potent. So I think that's going to send a strong signal to the market. And that's also, and in doing that, we're not just asking them questions. We will be proactively, one of the questions will be, would you consider opening a vehicle, or is there something you can do to provide a means for our clients to invest along ESG principles? And that's something that will benefit, that's what benefits all the clients. I think a real example of how we've expanded, a couple of examples of how we've helped expand product supply. We agree that emerging markets is a really tough area. So in 2010, we collaborated with other consultants to bring clients together and seed an emerging markets ESG fund with F&C Capital Management. And I'm not going to tell you that it's been a rocky ride at times in doing that, but the process of getting there was bringing together a group of investors that represented a little over $50 million so they could seed the fund. And there was an RFP process, and multiple managers responded to it. And the investors we sat alongside our clients and the other consultants at the table in interviewing the managers, and the investors picked the manager. And it's grown in assets. It's gathered some assets. I mean, it's been a difficult time in emerging markets, perhaps, but there's something there. On the hedge fund side, there's 10,000 hedge funds in the world. We think only a couple hundred are worth even talking to, high-quality institutional hedge funds. And so we felt very few could offer something to our clients that our religious clients in particular, wanted to do exclusionary screens. So we've proactively talked and engaged with hedge fund managers about whether they would have SRI share classes. And I think, finally, I guess the challenge that remains, and this will be, maybe I'll tee up for this afternoon, is that all of us need to kind of constantly reinforce that we have purpose, persistence, and patience. I think to your point, you can't rush there. Try, if you're going to divest particularly, you want to keep moving forward with purpose, with patience, and the persistence, but the patience is key. I think Tony noted at the outset. You won't get there overnight, but know what you're looking for and keep chipping away to find it. And hopefully our combined efforts and everyone's efforts to advance portfolios and really high-profile things like RBF, that certainly helps move the market and bring things to a better place.